Yesterday we started to see a bit of red creep into the market, which actually when we look at the last few weeks, it is still continuing to all-time highs. Lots of companies are in fact up double digit, which is quite surprising when historically September has been the worst performing month in the S&P, and therefore leads us to believe that this year things will not be as they have been historically. We're also noticing investor sentiment still sticking in greed, and today's episode is going to be highlighting 7 stocks trading at 52-week lows. Are they a buy, are they a hold, or are they a void? And we'll get into our own valuation. Stock number 1, we have Target, battered down 45% in the last year. Year to date, not better at all, down 36. And if you've been an investor over the last 10 years, you'd be up only 9%. That is a pretty terrible investment, where we're talking all-time highs around 4 years ago at $260. As we mentioned, it is trading right now at its 52-week low, massive way in fact, nearly 50% from its 52-week high. And quite interestingly, every analyst, fairly rare, has given the company a hold, Seeking Alpha, Wall Street, as well as Quant. Now, if we look at the forward valuation, it comes to 11.3. That is not only below the 5-year average at 15.8, but one of the lowest in the last 5 years, so a potential undervaluation signal. Couple that with the yield of 5.3, again not only well above the 5-year 2.8, but at a 5-year high, something dividend investors may like to note, and pretty reassuring that on a dividend safety score at 80, it does for the time being look to be safe. Now we'll also run through the dividend history of each of these companies. Latest one, very poor, not only below inflation at 4%, we get to note here 1.8 increase, but when we look at over the last 5 years and the last 10 years, this was a company that had, at least historically, been increasing those dividends at a very attractive rate. Now, one thing that you will like to hear is they are a dividend king. They have been increasing those dividends for at least 50 years, so that is a good sign, but ultimately we do want to see at a bare minimum above inflation increases. If we then move on to the blue tunnel methodology, as always highlighting the intrinsic value within the parameters, we get a potential undervaluation point given the disparity, trading price, and the lower end. But again, remember, never good to see the fair value over the period decrease. That is definitely something we would say for serious consideration. And then if we zoom out to the last 5 years, again, you can see this isn't one of those consistent companies, although probably no surprises given it is trading at its 52-week low, something that seems to be the case every single month. And then in terms of the valuation, while we look at Seeking Alpha, where they get an A- grade, ultimately they are trading at a discount to the sector. We're talking 27%, and as we just highlighted, a 34% discount to their historical. If you want to look at other valuation metrics for Target, the conclusion pretty much is very consistent. It's trading at a significant discount to both sector and the historical. Question is, does that warrant our attention? Now, institutions clearly believe it is one to consider with their 80% ownership, selling $7 billion, we're talking in just the last year. They've bought nearly twice as much at $13 billion, and they've also bought more than twice as much in the most recent quarter, $3.5 billion buys versus $1.4 billion sales. Now, for each one of the 7, we will get to our intrinsic price, where for Target we get to $102, the average of the 4 that you do see on screen. As always, when we do our deeper dives, we run through every single model, discussing inputs and outputs. Before we get in, we will just reflect on the DCF for those that prefer to look at it separately. Does come higher at $120, and we've actually used a forward rate of 0%, so no growth whatsoever to their future free cash flow, which you could argue is very conservative. In terms of a reverse DCF, well, this is flagging at the current market price of $86. Baked in is negative 3.4% decrease to the free cash flow year on year. Take that as you will. Now, in terms of a margin of safety, as always, 10%, bare minimum, we kick off, execute, buy, in fact, if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. We can already see that's a buy at $91, but ultimately, at the current price today, you're getting a 15% margin of safety. If you want to make note, at 20%, well, a buy at $81, and at 25%, a buy at $76. Now look, Wall Street themselves, even with their hold rating, see this as one for serious consideration. A yield above 5%, target price $104, translating to 21% upside. Let us know stock number one, target, whether you see it as a buy, hold, or avoid. Before we move on to the next one, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of September. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to the next stock, Bristol Myers Squibb, down 10% in the last year. Year to date, losing 1/5 of their market cap over the last 10 years. Actually, unlike the previous company where you would have been up marginally, you'd be down around 28%. So 10 years ago today, if you'd invested $10,000, as of today, you would be sitting on around $7,200. Not great at all, but maybe there's opportunity moving forwards. Trading pretty much near its 52-week low. We just get one respectable buy rating from Seeking Alpha at 4 out of 5. We get a potential undervaluation signal, 7 forward PE versus average of 8, and a yield 5.51, very similar to the previous company, and also above the average of 3.4, and another safe dividend score, which as always is great to note, especially given the disparity from the yield today versus the 5-year average. And whilst we did see a very disappointing increase just last December below 4%, that we always say at a bare minimum, over the last 5 years and the last 10 years, it has been a lot better. Now, in terms of their growth streak, it is only 18 years, but they have been paying a dividend for the last 54 without a reduction. And if we look at the blue tunnel, it isn't massively decreasing, but it isn't also increasing. And right now we are seeing it just outside the bottom end, hence why we have that potential undervaluation signal. But we should make you aware, if we were to zoom out over the last 5 years, the trend has been one that has been declining. So definitely something, again, worth just taking into consideration when you're looking at your own investment thesis. Valuation grade though is very strong at an A-. You're getting a 63% discount to the overall sector, but likewise, based on the Seeking Alpha data, a 63% discount to BMY's 5-year average, and very much reflected right across nearly every single metric. You are getting quite a substantial discount across both sector and their historical. It's another one institutions like 76% ownership, selling 10 billion, buying pretty much bang on double, and we also noticed them buying twice as much in the most recent quarter. So clearly one, at least for now, they are bullish on. Now our intrinsic price at $62, pretty much bang on what we see for the DCF, where we've actually used a negative 4% growth rate, so you can really see how conservative we're being in the episode, baked in negative 7.4. Very interesting. You may believe, yes, it should be decreasing, but not at a rate such as negative 7, and that could be where the opportunity lies. On top of that, a safe dividend, as well as, in fact, a very, very nice margin of safety. 28%, Wall Street themselves, whilst they see this lower than our intrinsic price, $55, 22% upside. If you want to make note, at 35% perhaps, a buy at $41, and at $40 for BMY, a buy at $37. As always, let us know your views on Bristol Myers Squibb. We then move on to Colgate-Palmolive Company, down 23% in the last year, year to date down 13%. Over the last 10, very poor, up only 24%. All-time highs pretty much a year ago at around $107, trading bang on its 52-week low, and we get just one buy rating from Wall Street at 3.9 out of 5. Now we also see a 5-year low in terms of valuation below 21, historically 24. Yield not as glamorous as the previous two companies, but 2.6, still above the 2.3 historical number, and actually the first one we've seen so far where we get a very safe score sitting at 90, which always is fairly reassuring. And they're pretty consistent in offering mediocre increases to investors. We're talking around the inflationary rate, and when we do take a look, this is another one that we have very similar to Target as a dividend king, 62 years of consecutively increasing, actually been paying a dividend for the last 130 without a reduction, and another one where there's no surprises that we do get the undervaluation point. Intrinsically though, it hasn't actually increased its worth, but what has happened is that the share price over the last year has started to dip, and therein lies a potential opportunity. And actually when we zoom out to the last 5 years, this one incredibly rare. You'd have to go to mid 2023 to see another point where it did show the undervaluation signal, but at the same time do factor in that the intrinsic price of this one hasn't increased that much within the period. Now valuation, not as good as the previous two, D-, you're paying a 33% premium to this sector overall. You're getting a slight discount to their 5-year average at 14, and actually depending on which valuation metric you look at, in most instances they are trading at a premium to the sector, but at a very slight discount to their own 5-year average. And institutions with their 80% ownership selling $8 billion in the last year, they've bought around 50% as much, but actually in the most recent quarter, like many of the companies we've looked at and will look at today, they've bought around twice as much. Now our intrinsic price, $93, again not too dissimilar from the DCF where we get $90. We've used 5% moving forwards below the average, and baked in is around 3.3. Always a good starting point just to understand what is the market currently factoring in for the growth moving forwards. And we notice 15% in terms of a margin of safety. At 20%, well, a buy at 75, at 25, 70, and we can go one step further, 30%, around 65. Wall Street themselves see this potential opportunity just below the $100 mark. That is 23% upside. Maybe one you like, maybe one in fact you want a deeper dive. Do let us know. We then move on to Old Dominion Freight Line, down 32% in the last year, down 21 year to date. Over the last 10, first one so far that has massively, even with the drop, outperformed the S&P, trading right there at its 52-week low. Bit of a traffic light system, buy from Seeking Alpha, hold from Wall Street, strong sell from Quant. Also, one of the more costlier ones today so far at a forward P of 28, although that is below the 5-year at 31. Yield, not the largest, 0.81, but as the highest they have offered to investors with the average at 0.4. And we get another very safe dividend score at 81. And actually, whilst we see a very attractive increase February this year at around 8%, over the last 5 years, this company has been increasing very rapid, 36% year on year, and in fact have only recently started to pay a dividend, hence why we get these 7 years of consecutive and 7 years without a reduction. Now this one we do see it in the reasonable signal. Again, intrinsic price hasn't moved much, but very similar to the previous company, the stock price itself has been decreasing. And if we zoom out to the last 5 years, we can see again another one that doesn't often show itself as undervalued. More often than not, actually, ODFL does trade at a premium, but we are starting to see, at least from the beginning of 2024, the intrinsic price start to drop. Valuation, it does get a D-, where you are paying a 38% premium to the sector, but you're getting a discount to their 5-year average. Again, pretty consistent like we saw previously. This one at a premium to the sector, but actually at a discount to their own 5-year average. And institutions, 78% ownership, selling $4 billion. They've only bought a little bit more at 5.2, and similar to that, in quarter 2, they've only bought around $300 million more. Now, our intrinsic value, $162. Again, not too dissimilar from the DCF, where we have gone for a growth rate of 12%. Baked in as of today sits around the 10% mark, and in totality we do see a 15% margin of safety. 20% though, a buy at $130, at 25, 121, and again if you want to see it 30, 114. Wall Street though, they do see this $170 into next year, upside of 23%. Let us know whether this is one that does interest you. ODFL. We then move on to the next company, Procter & Gamble, down 12% in the last year, year to date down 9%. Over the last 10, it has marginally underperformed the S&P 500, trading near 52-week low at the $150 mark. Just one buy rating from Wall Street, that is below 4 out of 5, but we are seeing their forward P at around 22. Historically, it doesn't deviate too much, but the average sits at 24. Yield of 2.8, above the 5-year at 2.5, but actually not near the 5-year high, which did sit around 2022 at 2.9%, but also not far off. The highest score obtainable as well in terms of safety at 99. We're pretty average in terms of their increases, around 6% year on year over the last 5, around 5% over the last 10 years, and it is also another dividend king. 69 years consecutive increases, 135 years of paying one without a reduction. Now we do also see it right there towards the bottom of the blue tunnel, something that historically this company does trade at a reasonable signal. In fact, when zooming out to the last 5 years, you cannot find this one trading at a severe undervaluation. More often than not, you would be better suited to dollar costing average when it does hit towards the lower end. Definitely one, again, something to consider. In our valuation, at a D, highlighting actually a premium for Procter & Gamble, 36% to the sector, bit of a discount to their 5-year average at 11%, and again, quite like a lot of companies we've looked at so far, bit of a premium to the sector, but at a bit of a discount to their own historical. Wall Street, 66% on the lower end so far today, but they've sold 20 billion. They've bought a lot more at 52. They've bought a huge amount in 2025 in the most recent quarter, 24 billion buys versus 4 billion selling. If we look at the previous one, again, they bought more than twice as much than they have in fact sold. Now our intrinsic price, $167, although DCF does come in lower at $158. We've used an 8% growth rate, baked in is there or thereabouts at 7.5, and as of today we see around an 8% margin of safety. 15% would make it attractive at $142, at 20% $133, and at 25 $125. Wall Street themselves on the lower end in terms of upside so far at 16%. They see this dividend king $178 into next year. Let us know, maybe you are more attracted to dividend kings, even if in fact the margin of safety and the potential upside is a little bit lower. We then move on to one we haven't covered in quite some time, very similar to Waste Management. It is Waste Connections, ticker symbol WCN, down 4% in the last year. Year to date, pretty much flat. Over the last 10 years, this one has massively outperformed, trading very, very close to 52-week lows. Another traffic light system, hold from Seek Alpha, a near strong buy from Wall Street, 4.37, would have to be 4.5, and a sell from Quant at 1.69. Now valuation is pretty high at 32, but is below historical 35, and like ODFL, the yield is below 1%, and in fact pretty much in line with their historical. Great to see, as always, a safe dividend score at 80, and actually this is one that historically does increase the dividend at a double-digit rate, 14% year on year over the last 10 years, and given they increase typically in October, it won't be that long before we find out what the increase is for 2025. They've also been increasing the dividend for the last 14 years consecutively, and like some companies today, we are seeing it right there towards the lower end of the blue tunnel. One again that in fact hasn't been trading in an undervaluation signal or at a premium, pretty much reasonable level. And if we zoom out to the last 5 years, conclusion pretty much the same. If you want this undervalued, you would have to go to middle of 2023. As always, make sure you're subscribed, notification bell is on. We will highlight high quality companies when they're severely undervalued. Now we do get an F on the valuation grade, trading at a premium of 63% overall to the sector, but a discount to their historical. Again, pretty consistent with the last few stocks. Premium to the sector, discount to the 5-year, but maybe some investors do like to specifically look at other valuations that aren't the forward PE. Now institutions, 86% ownership, selling 4 billion. They've bought twice as much, but they've bought a lot more in Q2, 2.4 billion versus 432 million selling. Q1, they've also bought a lot more than they have sold, so definitely one that institutions quite like. In our intrinsic price, $183, actually the opposite to what we've just seen. The DCF comes in higher at $203. We've used a growth rate of 8%. Baked in today is 6.3% moving forwards, but on average, using all three models, 183, giving rise to a 5% MOS. 10%, it would be a buy at 165, at 20%, a buy at 147, and at 25, $137. Wall Street themselves, near strong buy rating, 210 into next year. That is upside of 20%, but do give us your thoughts. Waste Connections, buy, hold, or avoid, or if you like Waste Management, let us know and we can take a look. We then move on to automatic data processing, up 6% in the last year, flat year to date. Over the last 10, another outperform of the S&P, trading nearish to its 52-week low. We get just one buy rating, although that is right on the cusp at 3.5, with a double hold from Wall Street and Quant, and a forward P 27, slightly lower than the average at 29. Yield not too dissimilar, 2 versus 2.1, but great to see a very safe dividend score of 97, coupled with the fact that this is a company that consistently pays a double-digit dividend increase, 12% on average over the last 10 years, and they're also very recent, a dividend king, 51 consecutive years of increasing. Now we are seeing something very similar with companies in just the last few, where they are trading right there towards the bottom of the reasonable signal, where for the large part they are trading in the blue tunnel parameters, and that is very consistent of ADP even when we zoom out to the last 5 years, although there were points, a handful in fact, over the last 5 where you could have bought this in an undervaluation signal. Now grading does come at a D+, but what we're noticing, those that in fact trade at a premium to the sector, more often than not, do significantly outperform the S&P 500, and like others, this one does also trade at a discount to their own historical. Now institutions hold 80% ownership, selling $7 billion in the last year, buying twice as much. They bought around 3 times as much, in fact slightly more over the most recent quarter, $5 billion buying, $1.5 billion worth of selling, and the same also noted in quarter 1 25. And our intrinsic value, $330, DCF coming strikingly higher at $379, where we've used a 10% growth rate, 6.4% is currently baked in. In fact, whilst the average is sitting at 12, so we've been more conservative, most recent year was also a lot higher at 20%. In turn though, using all three, and as always, you can grab a copy of this model by clicking on the pinned comment below, running your own numbers, whether it's ADP or any others, but today we see an 11% margin of safety, at 20% a buy at 264, at 25 248. Wall Street see this 328 into next year. That is upside of 12%. But as always, let us know if you like these episodes, the 52-week lows, if you want deeper dives, or your general thoughts on these 7 stocks today. Don't forget, as always, to sign up to the free weekly newsletter. Grab those spreadsheets. Come and join us in the Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.